It's Mike Lynch with AmeriFirst Financial. It's Monday morning. It's time for your Monday morning mortgage update for the week of October the 24th. Hope you all had a great week. And I always say that fall really doesn't get to us in the North State until Halloween. And Halloween's right around the corner. But this weekend sure did feel like fall. Cold weather, sweaters, blankets outside on the deck with a hot cup of coffee. It was a nice, cool weekend, and I hope you all enjoyed it. So what happened last week and what's going to happen this week, and how is this going to affect mortgage rates and what to look for this week in the market? Well, let's go right to the charts. Last week, we actually saw a sell-off on the market, but it was only down 32 basis points. So as you're looking at this graph here, just to refresh, this is a graph that shows the trading of mortgage-backed securities in the bond market. And each one of these bars shows 1 day of trading. You can see the date at the bottom there. As I move my cursor around, it shows the date. And I can go all the way back to the left side here on April 27th, and then all the way over to the right side, October 24th. When we see red, or that graph is moving down, that means money's flowing out of the bond market and mortgage rates are going up. So yeah, what we've seen since this summer, August, is just a really nice downward trend in the mortgage-backed securities market, where mortgage rates are determined in the bond market. A sell-off, nobody's buying the mortgage-backed securities, they're getting rid of them, and that's why mortgage rates are going up. And why are they doing this? It's inflation. There's a lower rate of return because of inflation, and until inflation gets under control, we're going to continue to see these rates go up. But last week, we only saw a 32 basis point sell-off, and you actually see on Friday, there's a little bit of a recovery, and even a recovery today. Now, why do I point this out? Because it seems like every week prior to this, for the last 30, 60 days, we've seen 100 basis point sell-offs in 1 week, significant. So we actually saw kind of a leveling off, or at least a shift in the trend on what's happening with that sell-off in the bond market. And I've been saying this for a couple of weeks. Does this mean inflation may be cresting? Is there signs of it? Does this mean we might see rates start to level off and not go up? Some people predicting rates might go to double digits to 10%. The data doesn't support this, but we'll take a little bit of a less of a sell-off. So again, that's what happened last week. So what are we looking at this week? We're looking at three main things. We're looking at inflation, we're looking at central banks around the world, and data. So let's talk about central banks around the world. As we know, we're a global economy. Every bank in every other country has their own equivalent of the Federal Reserve. They manipulate rates just like we manipulate rates when they have inflation, when they don't have inflation. And obviously, different countries have different policies and different mindsets. But we really have three banks coming out this week: Canada, the ECB, the European Central Bank, which is the big one, in Japan. Canada and ECB expect to raise their Fed fund rate, their equivalent of that, to fight inflation. The Bank of Japan actually is negative on their Fed fund rate, but are they going to change course? So everybody's feeling the pinch and the stress of recession and inflation. And we're really going to be watching ECB to see if they're going to be very, very aggressive on raising this. Now, remember, I said this about a month ago. The ECB they raised the rate, I think 2 months ago, 3 months ago, and they hadn't raised that or changed that federal fund rate or their equivalent of it for 12 years. So this is a very historic mindset that they have, and they're starting to raise it, and they expect to raise their Fed fund rate or their equivalent of it 0.75%. So it's a big deal for them, and we'll be watching that. How does that impact our rates? Well, if investors that invest in our bond market, and everybody invests, your 401ks are on the bond market, private investors invest in our bond market, foreign countries, foreign investors invest in our bond market. If there is a general sign that other economies are taking inflation seriously, because a lot of them have sat on their heels and haven't taken it seriously, but if there's a general sign that, hey, other countries around the world are starting to take this seriously, they're going to start to fight inflation, that means inflation ultimately might get under control, and that will start to drive rates down, start to make our bond market more attractive for people to invest in our bond market, because if inflation comes down, they'll get a greater rate of return, and that ultimately will drive rates down. That's why in a recession, when the Fed starts to lower that Fed fund rate, because they've got inflation under control. Money's parked in our bond market. We call it a flight to safety. Everybody puts their money in the safer bond market, and that drives mortgage rates down. So we'll be watching this week to see what those other economies do. So let's talk about inflation. This is one of our top three always, every week. The key measure, the favorite thing that the Fed uses to measure inflation, the PCE is coming out Friday. We expect that number to be up, but will it be up as much? Will inflation, will it be signs that inflation may be cresting? The Fed's been raising our Fed fund rate to fight it. And so will this actually work? Now, keep in mind that when the Fed raises the Fed fund rate, it doesn't take an effect or start to impact inflation tomorrow. It takes time, 3 to 6 months typically. And when we look at data today, when we look at these reports that we get on PCE or inflation reports or manufacturing reports or housing reports, these reports typically are 30 to 60 days old. So we're looking at old data. So when we see the big swings that we see in our economy, that's old data. And so if the Fed is moving rates today based on old data, do they have to kind of project where the effect of raising that Fed rate, where it is? And so this is one of the complaints or a lot of the kickback that the Fed's getting right now. They're driving us into a recession, but are they driving us so hard that they're kind of looking in the rearview mirror and they're not really looking at some signs now on what the effects of this Fed fund rate is doing? Is it affecting inflation now? And there's obviously other things that they can look at besides these reports that are always 30 to 60 days back. So we'll really be watching that PCE report and the real impact that the Fed fund rate's having on cresting or curbing inflation. And then the third and the last thing, just a lot of data coming out. We're going to see consumer confidence come out, manufacturing home information come out. So consumer confidence, if consumers feel bad about the economy, that means the economy is weakening, and that actually is better for pricing. And we've had some bad reports consistently over the last few months. So will that trend continue where consumers just don't have a lot of confidence in the future? Manufacturing data has really not been very strong, meaning it's weak, meaning that companies are not making as much stuff. And is that a sign that our retail market that's coming up in the holiday season is going to be weaker? Do they see signs the economy is weakening? That could be better for rates. And then home prices. We don't expect, we got a home price index and new home sales and some other home stuff. We expect it all to be weak. It's not good for our business. How will that move rates? Probably not move it that much. We're just going to get a lot of home data. And what that does is that causes our buyers and our sellers to see that and say, oh my gosh, it's bad, it's bad, it's bad. And then we really have to start impacting our conversations we have with them. So I'm throwing something in here that I've thrown out there before, some scripts, some really key scripts that you can use with your buyers and your sellers. I put a link down below. I want you to click on that if you want some great scripts about how to have impactful conversations about what's happening with this economy, what's happening with our housing market, and how we can have those impactful conversations with our buyers or sellers. So what are we looking at this week? We are cautiously floating because it's going to be a volatile week, which is nothing new. If we start to see trends of those rates going higher, obviously we'll lock. I hope you have a wonderful, productive week, and I'll talk to you next week. Bye-bye.